So when we look at the real estate debt markets globally, we can define our thoughts in three different ways. One, what is the opportunity, the credit opportunity? It is real estate debt, so what are we looking at from a real estate perspective? And then what, from the investor's eyes, is the demand and how we can fit that all together. So with the credit opportunities we see around the world, there's some key structural themes. Clearly, regulatory change has increasing impact on the traditional providers, opening a wider funding gap to alternative lenders. We've got the increasing impact of ESG and requirements for properties to be different, better, for a variety of reasons. So that requires capital expenditure and actual investment in market. So that's another driver for demand for capital. But in the context of the overall market, we are dealing with very large markets around the world, totaling about 8 trillion. So there is an increasing structural opportunity within credit markets themselves. Attached to the issues around what opportunities are in the real estate markets, either regionally or by asset class. And we go back to, we heard earlier in the conference, we have our Ds, which are digitalization, decarbonisation, and demographics. When you look at those with respect to impact on real estate, it's critically important because people look at debt from a perspective of being paid coupon. Actually, the biggest issue and biggest risk in debt is being repaid at the end, which is critical to look at what your property is going to look like in 3, 5, sometimes 10 years' time. So future-proofing. So digitalization, examples, everything obviously from last mile logistics to, for example, cold storage is another one, the different way people buy and sell and the impact on real estate. So we look at funding those. Look at decarbonisation. There's an immense amount of embedded carbon in existing buildings. So it's not all just about knocking buildings down and building new ones. It's how to future-proof and change existing buildings if you're really focused on decarbonisation. And then demographics, different types of residential across different age groups. Student accommodation, fit for purpose, all the way through to affordable living, traditional private sector, all the way to later living. So all these things we look at when what we want to lend on from a real estate perspective. And then taking about where are the best opportunities. I've got my global hat on. I look at Europe, for example. The number one issue is still the reduction of bank lending, the dominance of banks being less dominant and the wide opportunity being offered. So very much, what are the opportunities left by banks? I think on the senior debt, traditional senior debt, there'll be a role to play as banks get more expensive. And then on the funding gap side, value add, refurbishment, that's a classic example of what's available in Europe. If I look over in the US, there are those opportunities, and obviously we'll have stresses in this market. But what I see is half of the lending in the US is actually residential multifamily. So if you want to balance your books, and that number in Europe is 17%. So I look at US, if you want to go a bit more overweight in residential multifamily, you look at inflation, you look at cash flows, you look at granularity and stability, that's maybe something to look at over there. If we look at Australia, for example, in Asia Pacific, there it's less about return, but actually, for example, in construction or development lending, there are very high potential returns you can get in a very comfortable senior debt position, very nuanced to the structure in Australia. I'm not saying these aren't available in all the countries, but there are possibly 3 examples there of what perhaps a global approach to looking at the markets are. And if I just finish off with, from an investor viewpoint, that no matter what's going on in the market now, a few years ago, the structural trend of public to private very much started. If anything, the trade-off between volatility and liquidity is becoming less, so people are looking at privates and saying actually they're not that much less liquid because publics weren't that liquid anyway. But people are looking for spread, long-term spread. So we've got that shift in capital sources. So when we look at real estate debt, I'll look through 2 lenses. One, the role of what I call private investment grade, not necessarily rated, but low risk, low volatility, maybe internally rated debt, and as an alternative to traditional fixed income. And through the other way to the higher yielding side, which encroaches both on the private credit world, so mid to higher single digit into double digit to alternative to real estate, we see flows of capital in there. So we look at strategies that people, not just one end, low risk, spread based, all the way to total return based, but what we're also seeing from investors is solution based products, which is, for example, using all of them, using barbell strategies. And all those things are quite new for us in real estate debt. So I think we're sort of quite near the beginning of what could be an interesting evolution in our markets.